Hello, I am Jason Bates, owner of Electrum Financial, where a mortgage is not just a flip of the coin. So if you're looking to refinance or purchase a home, I certainly would love to be your lender of choice right here in the state of Arizona. So please reach out to me. I'd love to help. If you're watching this on Roku or on Amazon Fire, please write a review of the channel. The app to download this video on those channels is called Prem TV. So please tell your friends and family and download the app. Appreciate that. All right, so let's jump into inflation. What is inflation? How does it affect mortgage rates? I want to pull up some things here and go over this real quick. This can get kind of boring, but it is super important. And you may have seen some things on the news talking about inflation. You may have heard of Jay Powell talking about inflation, and the market's reacting to that. So I want to kind of address some things here. And then I also want to talk about this past week, what the Fed said and then kind of didn't say, because you got to read between the lines when it comes to the Fed, right? So I want to bring this up. So let's bring it up here. What is inflation? Number one, what is the definition of inflation? Inflation, in economics terms, is a general increase in prices and fall in the purchasing value of money. Quotes, policy aimed at controlling inflation. There are policies that can be put in place to help control inflation. So now, why is inflation bad? Bad for bonds. Inflation is bad for bonds. It erodes the value of money. However, inflation eats into the purchasing power of every dollar you receive from bond interest in the future. Since the interest payments are now less valuable as inflation rises, your bond is less valuable. This causes the price of bonds to drop. Now, why is this so important? That's because mortgage companies borrow against 10-year treasury bonds to loan to you. Now, they don't get all their money from that. They get some of that from deposits and interest and other things, but they do also borrow against the 10-year treasury. Now, why the 10-year treasury? That's because the average life expectancy of a mortgage is anywhere between 4 to 6 years. And you either refinance, sell the home, do something with the mortgage, even though your mortgage is 30-year note, and it's out for 30 years, and you may live in the home much beyond 6 or 4 years. The average life expectancy of that mortgage is 4 to 6 years. So they borrow against that 10-year treasury. And if we have inflation, that erodes some of the yield on that 10-year treasury. And now the companies can lose some money or start to erode into their yield on that particular mortgage. So inflation can have a negative effect, not only on the bank side, that's kind of the bank side, but remember too, it's on your pocketbook, right? So if I give you $2,000 as a loan every month and I'm paying you, or you gave me a loan and I gave you $2,000 as a repayment, and you took that $2,000 and you bought some durable goods with that this month, and you got X amount for that $2,000, if inflation rises, now that $2,000 doesn't buy you as much. And so now you're having to spend, instead of $2,000, you spend $2,200 to get the same amount of goods. This is inflation. And so when you're doing that, that takes away some purchasing power for homes as well, for you to purchase and make your house payment, right? Cost of living is kind of what it's referred to as well. So I want to show some trends here that inflation that you may or may not be aware of. So let me pull up the inflation chart here and kind of let's look at that as well. So this is the inflation chart, current U.S. inflation rates 2009 to 2020. And you can see right here in 2020, we're at 1.3%. So not near the 2%, but I'll show you another chart here that does kind of go up there. Now you can see over here on the trend, it was 2%, 2.1, 1.9, 2.3. So we're averaging right around that 2% right there. But now we've taken quite a bit of a dip. This is at 1.3 right now. It was actually lower because if we look at the PCE, which is the personal consumption expenditures, which is really, this is the chart that the Fed really watches very heavily. They don't really look at anything else other than this. And why do they look at this? That is because they look at this chart, or this barometer, if you will. This excludes food and energy. And so this really gives you a cost of living inflation rate, if you will. How far does your dollar go to get everything except for food and energy? And if you look at the last sentence here, the core PCE price index is closely watched by the Federal Reserve as it conducts monetary policy. So they're really watching this. Now, if we look at the past 3 months, yes, we're at 1.3% right now. We're 1.1, or we are 1, 1.1, 1.3. So what we have then is we could have what they call accelerated inflation. And accelerated inflation makes it very difficult for the banks to say, hey, look, we know inflation's coming and we can take a steady increase in inflation and we can forecast and adjust rates accordingly. But if we have accelerated inflation, then all of a sudden, now what I lent to you today, that $2,000, now all of a sudden it's accelerated where that $2,000 only now you need $3,000 to purchase the same thing. The same thing with the banks. When the yields are getting eroded and they're getting eroded very quickly, now all of a sudden they've got to raise prices very, very quickly, and that can cause a little bit of panic. So this is where this past week, the Federal Reserve came out and said some things, and we'll cover that here in a second. But I want to show you another chart here. This is something that I watch on a daily basis when I'm quoting you rates. I'm checking out what's happening with the markets. And this is one of the things that I'm going to share with you here that will help, I think, maybe get this kind of and put it in perspective, I should say. So here on the left-hand side, we see the UMBS, that's the mortgage-backed securities. We have different buckets here, 2%, 2.5, and at 3%, these are different buckets that they'll put mortgages into. On the right-hand side here, we see U.S. Treasury yield. Now, when we look at this chart here, back in January here, we're cruising along. We're kind of steady Eddie, right? Not too bad. And then all of a sudden, the pandemic hits and boom, craziness happens, right? Now, we did have some return to that back. When was this? In June, we had some upticks in here, some volatility in the market. And then here, as of recent, if we click on let's just click on the 5-day this past week here, we will see that this is more or less in a flat pattern here over the past week. And this is consistent with what they're trying to do, which is keep these yield curves in a manageable pattern, if you will. So next thing I want to go over is the notes here, Federal Reserve and the interest rate snippets from this past week and the meeting this past week. So Chicago's Fed Evans. So he spoke, and I want to take away some bullet points about what he said, because this is where you got to read between the lines here. So Fed Evans says expect U.S. unemployment rate to fall maybe below 7% by the end of the year. That's a good thing. Fed Evans says inflation will continue to be challenged, will underrun 2% for a number of years. So they're predicting that even though we're starting to see an upward tick, remember 1%, 1.1, 1.3%, we still will probably see this stay under 2%, even though Jay Powell said just at the end of August that he's not opposed to having or allowing the inflation rate to go up to 2.5% before he acts and does anything to help with that. So a little bit of a tidbit there. So Fed Evans says it will be necessary to maintain accommodative policy for years given low inflation. Yes, they're willing to do things. That's good. Fed Evans says bigger overshot on 2% inflation means it would get to an average of 2% more quickly. Evans says we'll need to have more Fed committee discussions about asset purchasing. That is a good thing. That means they're open to purchasing more mortgage-backed securities. That's a good thing. That will help. That has helped stabilize the market. And we can see that this past week it has stabilized things there quite a bit. Next thing here, Evans says quantitative easing more complicated than back in 2012 when rates were higher. I would agree with that 100%. Evans says yield curve control would likely be a statement about interest rates for perhaps 6 months or a year. So they're willing to help control the yield curve to help keep interest rates not so volatile, where one day they're way off. Mortgage companies do not like that at all. I don't know if you watched some of my past episodes about rates were changing hourly, minute, every 15 minutes, we're getting a new rate change. That's not good for anybody. Nobody can do anything. We almost shut down. It was a chaotic mess when this pandemic hit initially and the economy shut down. So not good. So they're willing to do things to help keep that yield as a curve, not a spike kind of thing. So that's a good thing. We like to hear that. Fed Evans says at the moment, 10-year Treasury rates are quite low. Don't see any issue with that. That's good. Fed Evans says we are not going to be concerned if unemployment rates go very low, as long as it is consistent with 2% inflation. here's the one comment here that I really like to hear and see the Federal Reserve say. Federal Evans says he is open-minded. Okay, a key word, open-minded about further bond buying, but big questions at the moment are about fiscal stimulus and agitated demand, or aggregated demand. This right here, the word open-minded, okay, that means they're willing to do things to help stimulate the economy. They are not so closed-minded to say, no, we're going to do it this way, take it or leave it, sorry, deal with it later. They're being very, very open and keeping the economy stimulated and keeping it going. So I think that is a bold statement by the Federal Reserve, and I really like to see that. And I think the bond market has reacted accordingly as a result. And lastly here, Fed Evans says at the moment he doesn't see open-ended quantitative easing, QE, as providing an important part of the answer. So quantitative easing isn't necessarily the issue here. I think more importantly, it's the stimulus and who's going to get it, who's going to get the PPE or PPP money, how's that going to be distributed, who needs it, do restaurants need it, what's happening in the economy, buildings being burnt down, all this kind of stuff. I mean, there's a lot of uncertainty. There's still uncertainty with the election. So there's still a lot of uncertainty. So he's basically saying, hey, look, we'll do our part on our end. We're open-minded to doing what we need to do. We're just not sure what the political side of things is going to do for the confidence of the American people. So the good news is the Federal Reserve is on standby, if you will, ready to do what they need to do to make things happen. But we need to watch inflation. Inflation can be pretty ugly, but the Federal Reserve is willing to step in and make things right. So that is a good thing. Don't forget to subscribe to the channel, hit that notification bell, tell your friends and family, write that review on Roku or on Amazon Fire. Would appreciate that. Remember, Prem TV on Amazon Fire or Roku. You can download this and watch this without having to watch the YouTube commercials. So that is this week's My 2 Cents.